David, good to see you. Thank you so much for being here. Your takeaway from the Fed moves yesterday.
Hi, Maria. Good morning. I think the rate cuts were too small and too late. They should have started in June, and you can wonder, why did they wait until now? If they're going to make the cuts now, the cost to the economy has been huge because they didn't start earlier. You know, all the interest on the national debt is paid at this rate that the Fed is setting. But that's done. So now looking forward, my worry is that they're going to continue leaning against growth into 2026. That has political consequences. That has real-world consequences for people, for their jobs and their mortgages. So my worry is the Fed's model is so old. They're using 50-year-old models, Lord Keynes models, to run the economy, and it's harming the economy.
Maybe, but I guess my question is, are you sure that just because the Federal Reserve cuts interest rates that it actually trickles down to mortgage rates? Because I don't know if that's true, that just because the Fed keeps cutting rates, it catches up with mortgage rates so quickly.
That's exactly right, Maria. That's what's been going on the last few months. They've been talking about cuts, but the 10-year yield is stuck above 4%, and that means mortgage rates are too high. They have to change the model, the concept of what they're doing with financial markets to give more assurance that they're defending the dollar. That way, the whole yield curve can come down. It's called a price rule monetary policy. Right now, what they do is inflation targeting, which has been wrong for 30 years. It's just a model that doesn't work. So if they shifted, then you could have 10-year yield lower as they lower the short-term interest rates. There's no reason the U.S. economy, as strong as it is, should be paying this high an interest rate across the board. That it's because people don't trust the Federal Reserve on the dollar and on the model. They think it'll be somewhat random walk in terms of how the Fed sets interest rates. That's what we saw in the Biden administration. They didn't know when to hike. They didn't know when to cut. And it ended up being a political decision. So they've got to break out of that model, create an actual workable new model for the modern age. And that would give us lower interest rates across the yield curve. That means mortgage rates could come down for a change.
That's very smart. Meanwhile, the president is moving ahead with his final interviews for the next chairman of the Federal Reserve, beginning with former Fed Governor Kevin Warsh. The president says he's, quote, looking for somebody honest with interest rates. The short list, of course, also includes Kevin Hassett. He is seen as the front runner here, along with Christopher Waller, Mickey Bowman, BlackRock's Rick Rieder. Powell's term ends in May, as you know, although he can remain on the board for 2 more years, David. What do you think President Trump ultimately does here? What would that mean for rate policy? Give us your thoughts on navigating this chairman of the Fed job.
In the vote yesterday, we saw the magnitude of the problem. 6 of the 19 FOMC, the Federal Open Market Committee members, but basically the board of governors of the Fed, didn't even want to cut yesterday. And that number, I think if you did the poll now, the majority wouldn't be cutting again. And so that means that you have to think of it in terms of how do you get the board, the whole board, to go in a new direction. And the problem is most of the board will be carried over into 2026, and they'll be fighting growth as they have been now. Their models are set up to say that the economy has a speed limit and you can't go above the speed limit. Well, that is diametrically opposed to what President Trump is doing with energy reform, for example. You want faster growth, but the Fed says that will be inflationary. So I think that as they choose a new chairman, they have to be cognizant that they need to have the whole models change so that we can have a growth economy.
Yeah, great point. And of course, a growth economy is what President Trump is prioritizing. That's why he's talking about this $18 trillion in new money investment into the United States, as he's luring all of these countries and leaders to invest in America, and also trying to rein in inflation. I want to get your take on the next major events for markets and certainly for President Trump with regard to economics, and that is the Supreme Court's decision on the emergency use of tariffs. Yesterday was the last day for the Supreme Court arguments in 2025. So that means we are going to hear any day now, any moment, any day, the decision on whether or not the president has the right to use the emergency, that's the IEEPA, International Emergency, as a reason to put tariffs on countries. The big question, of course, is whether or not the Treasury is going to have to pay back $100 to $200 billion in revenue already raised through these tariffs. What are you expecting, David? And I know that the administration has been talking about backup plans. There are several constitutional statutes like 122 and 338 and 301 that they could use to replace any tariff revenue that could go away, but it would still be a blow, I think. What are your thoughts?
These are difficult issues because of the way the words in the law read and how the Supreme Court thinks about it. They're making major changes toward the strength of the executive branch. That's the core of some of these other Supreme Court cases that they're going forward with. So I think there'll be areas where the Supreme Court can side in favor of the executive branch and of President Trump in some areas, but then not in all areas. So on IEEPA, it's an area that I'm familiar with from my years in Treasury. This is a difficult one because of the definition of an emergency. The president should be able to declare emergencies, and the Supreme Court will be deciding what the boundaries of that are.
Yeah.
So the way you phrased it is right. There'll be some alternatives for them to use to protect the U.S. from predatory trade practices abroad. I think they'll use those to make up for whatever narrowing has to be done on the IEEPA authority. Maria, one issue is this weakness in jobs, and I do want to put in a word that the small business lending is still weak within the economy, and it's vital that the Fed's models allow small business lending. That's what Powell was talking about yesterday with the jobs being weak, but the Fed doesn't really have any solution that it's looking for that will allow the job growth at the small business level that everyone needs. That's when young workers get jobs. They go to a small business, and those people aren't getting loans right now.
I agree with you on the jobs picture. This is murky right now, partly because of AI and the AI efficiencies that are replacing jobs. I know President Trump is working on continuing to endorse trade schools. We need more electricians, more plumbers, but also a framework on AI. David, we'll keep following that. Great point. Good to see you this morning, sir. Thank you.
Thanks, Marie.
David Malpass.